Okay. Okay, that's great. Thank you. Right, hello, everybody. Thanks for being in today's session. This is Adrian Boothie speaking. Well, what is it? The 2nd of August, 2022. And today we're going to be talking about how to trade the 4-hour chart. So hopefully you can hear me all loud and clear. If you can, please do let me know. Now you can type a message in to go to webinar. So that would be hunky-dory. Alternatively, we are streaming on a few other social media platforms. Now, it's going to be difficult for me to moderate all of the chat there. YouTube, I'll give it a go, but certainly on GoToWebinar, if you want to register directly with that, you can just get in touch with us and we can figure that out. So, but if the sound's coming through, please do let me know. Just type hi or hello or something like that in the questions box. If you're not too sure what to do about all of that, then the instructions are on screen now. So you'll see on the right-hand side of your screen, if you're on the browser, there'll be a question mark button. Hit that, and then you can type something in. If you're on the downloaded GoToWebinar platform on your PC, it'll look like the question mark here, and then you can type a questions button there. If you're on your tablet or smartphone on GoToWebinar, then you'll have the question mark at the bottom there. Hit that, and then again you can type in. So if I can get as many people doing that as possible, that'd be great. Just so I know it's all working. The thing about doing these sessions live is that I don't really like talking to myself, to be honest. It's a bit weird. Ideally, as much participation as possible. If you've got questions, get them into the questions box, and I'm delighted to go through questions really as we go through it. Okay. Good. Well, let's get on with it, shall we? So today is all about the 4-hour chart, and there's a lot to go through. We're going to be talking about why it's a good time frame, or it may not be for you, but what are the merits, I guess, of trading off the 4-hour chart? What are the pros? What are the cons? What are the certain things to think about? Whether it's economic data, what are the best times of the week to be trading it? What are the best markets to be trading it? And we're going to be talking about different filters, different strategies that we could apply as well, and the way in which we do it here. So there is quite a bit to go through for sure. Before I do get into all of that, a little bit of housekeeping, I'm afraid to say. So spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. There we go. So without any further ado, let's get started, shall we? So first thing I want to talk about today is, and the way we do these sessions, the screen share sessions, is first of all, we do get a bit of theory out the way first. For 20 minutes, half an hour, I always try and condense it down, but I end up talking on and on and on. But anyway, 20 minutes, half an hour, we'll get some theory out the way, because whilst I know lots of you say, just look at the markets, look at some charts. If you don't know why you're looking at things in a particular way, then you're not going to repeat it. You're not going to do it the right way because you don't know why. And why is very, very important to make sure you stay on the right path with your trading. So the first thing, time frame is very important, because if you're on the wrong time frame, I think a lot of people, they focus too much on strategy, which is obviously important, and they focus on which markets to trade without asking probably the most important question first, which is the best time frame for me to trade on. You can then work out the other stuff from there, but the time frame is super important, because if you're on the wrong time frame, you're going to miss loads of trades. You're going to place trades because, hey, you want the markets to dance just because you've got a bit of spare time, but the markets don't work like that. Just because you happen to be looking at the markets at that time doesn't mean there's something setting up. So often people will enter trades early, or they enter trades late before their strategy is confirmed or after the strategy is confirmed. That can make a very big impact on your success. And also, you need to consider how much you can actually monitor the markets as well. These are really underrated ideas that traders must consider. And let's go through each of these. Missing trades. Why is it important, when you're missing trades? I think the way I kind of look at it is that if you've got a strategy that, let's say, has the ability to make you, 1,000 pips in a month, for example, it's only worth 1,000 pips to you if you can follow it. Now, if you're missing lots of trades, all other things being equal, you're not going to be making 1,000 pips. You could be lucky and you could make more than that because you missed some loss-making trades. But I guess we'd all probably realize that you're probably more likely to miss a percentage. So if you can only take 50% of the trades that are available on a particular strategy, and the strategy is made 1,000 pips, then stands to reason that on average, all of things being equal, you'd probably only make 500 pips. And that's okay as long as we recognize that. But the problem with it is that the smaller the number or percentage of trades that you're looking to take, the less um, the less your results will be relative to the strategy itself. So what that means is the fewer the number of trades as per the strategy itself, the more likely is you could lose, even though you've got a winning strategy. So, for example, if you only manage to take 10% of the trades, you'd be pretty unlucky to do this, but you could actually take all the loss-making trades from a particular strategy. It could be a perfectly good month or week or whatever of trading, but you've somehow managed to make a loss. Whereas overall, over the whole period, over all the trades, then you could end up still not making money, which would be horribly frustrating. And that's largely down to probably the time frame of choice not being appropriate for you. Okay, so you can snatch defeat from the jaws of victory. You can have a perfectly good strategy and lose money with it, even though it's over a profitable period. And that happens a lot, believe you me. And being on a strategy which, I guess, reduces the likelihood of you missing lots of trades tends to be in your favor. Okay, we're going to talk about different time frames in a second. Obviously, boredom trades, again, expecting the market to dance just because you happen to have a spare moment is just madness, really, and yet lots of people do it. So what happens there is people think, okay, let's have a quick look at the markets. I've got a spare half an hour in between all the such stuff that's going on. Let's have a look. Okay, well, nothing quite sets up with my strategy, but you know what? I'm going to put a trade on anyway. I'm going to break my rules. That's assuming you have rules in the first place. And I'm going to place a trade anyway because, hey, why not? I need to do something with that half an hour of time I've just put in. And you end up breaking the rules and doing all sorts of weird and wonderful stuff, which generally will be loss making. So it's not a particularly clever thing. Okay, so to be looking at a strategy that's never sets up when you can look at it, it's not going to suit you. Entering trades late or early. Entering trades early is a big problem. I think that it's relative. Entering a trade before a trade is actually confirmed is an important thing because, when you're talking about indicators or price action in particular, really a lot of the decisions should be made, apart from maybe breakout strategies, but a lot of decisions should be made based on the end of a candlestick. So when a candlestick finishes, because it's only at that point when an indicator is actually set and locked. So think about moving averages, RSIs, and so on. Whilst a particular candlestick like the daily chart or the 4-hour chart or whatever it is being plotted, it's still being drawn, we're still in the middle of the day, the indicator associated with that is also still being plotted because it's relative to the candlestick itself. So what that means is if I'm trading off a daily chart which closes at 10 p.m. tonight, making a decision now at 12:30 in the afternoon, that's a bit sort of nutty because there's an awful lot of price movement that can take place between now and 10 p.m. that will change the size of and dimensions of the candlestick, which could and probably will change the indicators themselves. So what looks like a trading opportunity now may not be a trading opportunity at 10 p.m. What that means is by entering trades really early, often that you get a big tracking error against the strategy you're trading because the opportunities you're looking at can look quite different now than they could look at 10 p.m. or when the strategy is supposed to be traded. That said, you don't have to be bang on with it, but what you've got to do is reduce the ability of that tracking error. So for me, I often trade on a daily chart, so 10 p.m. is the time, but I'm often getting trades on from sort of 8:30, 9 o'clock onwards. So, it doesn't have to be bang on 10 o'clock, that's not a thing, but certainly, in the realms is useful. Entering trades late is a really important thing, actually. Generally speaking, what a lot of traders will do. In fact, let me ask you a question. Let's say you have a strategy, and let's say your trade was triggered yesterday, for example, but you weren't there. You were down the pub or whatever, which is fine. And you look at a trade now, and it's at a lower price. So you were going to buy this market, and it is now at a lower price than it was yesterday. Do you think you're likely to still want to take that trade? Okay, gives a yes or no. So let's say last night the market was trading at 100 pence, something like that. Now that was where the price was triggered. That's where the strategy gave you an entry. Now you look at it and it's trading down at 95 pence. Okay. Do you think you're likely to get in? It's a lower price, isn't it? It's better value, isn't it? Do you think you're likely to enter it at that lower price? Give us a quick yes or a no, guys, in the questions box. See if we can get as many yeses or nos as possible. That'd be great. Okay, a few yeses coming through, a few nos. This would be a buy. Okay, this would be a buy trade. So you're going to try and buy something at 100 pence. That was when it was triggered yesterday or whatever. The trade's still valid, still okay with it, but it's now trading at 95. So it's eased back a little bit, and you're thinking, oh, okay, should I get into it now? It's not 90 at 100 anymore, it's 95. Does that represent better value? Maybe not. A lot of no's, a lot of yeses. It's cheaper though, right? Really the answer in my opinion should be no, but we're going to talk about why in a second. What about if the market was trading up at 105 pence? So it was a buy at 100. It's now trading 105. You look at it the following day and you think, oh God, okay, I missed it last night, but it's at 105. Would I back it now? Again, yes or no. To question B. I guess this is a very simplistic thing. You don't know what the target is, you don't know what the stop loss is, and all that sort of stuff. But I guess the question is, are you more likely to buy an opportunity at a higher price than the strategy gives you, or at a lower price than the strategy gives you? So Carlos is saying no, because there's less profit. Okay, but he wouldn't do it at a lower price either. That's interesting. Lots of no's coming through. Okay, a few yeses coming through. Very mixed bag, actually. What's actually happening here is that if you're entering a trade late, like the day after or 2 days after, it's not quite the same trade anymore. Something's already happened. So what do we know about this? Well, let's think about it in sports terms. This at 100 pence is the starting lineup for a horse race, for example. Okay. Now, straight out of the gate, within the first 10 meters, our horse that we were interested in backing has actually stumbled and fallen. So it's actually suddenly last in the field. So its price has gone down, if you like. It's not going the way we expected it. We expected it to be leading from the front after 24 hours, but it really isn't. It's actually going the wrong way, and it's really at the back. Would we choose to now back that horse now that it's last in the field? Probably not. And certainly not unless it was going to start to overtake those other horses. Okay. By and large, what traders will do is they'll look at a price and go, oh, that's cheaper than I thought it was going to be. Therefore, it's better value. Therefore, I should trade it. But actually, it's not the same horse anymore. Well, it's the same horse, but it's not in the same position as we were expecting. And therefore, the chance of this trade going on to be as successful as it might have been before is probably less now. Okay. So actually, you're looking to back a horse that's already losing its race. Doesn't sound particularly clever. On the flip side, of course, looking the following day, again in horse racing terms, you're looking at a horse that's already now winning the race. It's got great out of the gate. It's had a really good first 50 meters, whatever it is, I don't care. It's going the right way. So it's already moving in the direction we want. Let's say our target's at 120. I don't know, it doesn't matter. But the point is, it's already moving in the right way. Are you more likely to back a horse that's already winning the race for a race that's in the running? I think you probably are. And yet, when it comes to trading, most people wouldn't do that. There's such a weird contradiction between how traders would probably speculate on sports as they would on the markets. We would be more inclined to back the horse that's already fallen than we would to back the horse that's already winning the race when it comes to trading. It's a really, really weird thing. So, what does it mean? It means that probably if the market's already doing what we expect it to do, that's a really good thing because it's more likely to be a winning trade than it would be otherwise. Because don't forget, if our stop loss is down at, say, 80 pence, in order to get down there, it's got to trade at 95. So we know in order for it to be at 95, it's got a stronger likelihood of being a loss-making trade. So actually the success rate at backing at 95 is quite a bit lower. So the point really is that bias and the way in which we think about the opportunities is likely to be a little bit different. So entering trades late can be quite problematic because of that horse race analogy I tried to give you earlier. Okay, hopefully that made sense. Did that make sense? Let me know in the questions box. What about 30 minutes late? It depends on the time frame you're trading off, Paul, really. If you're going to trade on something like a daily chart or a four-hour chart, that's probably okay. It's probably not a problem whatsoever. You've got to think about it relative to the time frame that you're trading off. If you're going to trade off a 2-minute chart 30 minutes late, the trade's done. Most most people are probably already out of that opportunity. So it's really a relative kind of answer there, Paul, I guess. Yeah, does that make sense, everybody? Give us a quick yes or a no. It's a relatively complex point, but I think if you think about things in sports terms, it tends to make a lot more sense. And you start thinking, what on earth am I doing it that way for? Totally mental. The ability to monitor it. Look, the shorter the time frame, the more you need to watch the charts. If you don't have much time to look at the markets, then you need to be trading on a higher time frame. That's the simple reality of this. Okay. Avi, if everyone is making money trading, who is giving that money to us? Well, it's an interesting question, but of course, not everybody does make money trading, so it's a bit of a moot point in a way. The thing about trading is it's an interesting question. Trading is not wealth creation. This is not about wealth that's created over a period of time by companies growing and employing more people and generating more revenue and creating new and exciting markets and all that sort of stuff. Trading is nothing like that. It's not wealth creation in that way. So in order to be successful as a trader, if you think about it rationally, that money has to come from somebody else. It comes from the ether. It's not like you're trading against Joe Blogs out there and making money off one particular individual. It's trading. It's out of the masses, as it were. But in order for you to extract profit, ultimately somebody has to be losing, and that's the way it is. So in order to be a successful trader, what does that really mean? It means we're competing. It means we're competing against all those other people out there. We need to be better prepared, have better strategy, and so on in order to be successful over time. And the good thing is that there's an awful lot of people who don't attend webinars like this, who have no idea how to trade, and they lose money hand over fist, sadly. But that's the realities of trading. Really, that's basically how it is. Okay. So hopefully that's useful. Now that we know a little bit about markets, time frames, and so on, we need to think about what the best time frame might be. Now, I'm going to be focusing today on the 4-hour chart, okay? But choice of time frame is important. And so for some people who can only trade for maybe 20, 30 minutes a day, the daily chart will be the great time frame for you, okay? Or the inclination is to spend that amount. You might have 5 or 6 hours, but you don't want to spend that much more at it. So which is fine. You don't have to spend that long at the markets if you don't want to. Daily charts can be perfectly reasonable. For those people who have a bit more time, maybe self-employed, maybe computer-based, maybe you're retired, something like that, trading off something like a 4-hour chart can be a good option, because what happens is you have a trading opportunity or an opportunity to look at the markets on each candlestick close. So when you trade off a daily chart, each candlestick represents one day, which means you can look for new opportunities once per day. It's basically how it works on the candle close. With a 4-hour chart, it's every 4 hours. If you're trading a 24-hour market, there are 6 candlesticks in a day, which means there's 6 potential entry points that could be taking place for any particular market. So that gives you more potential trades than a daily chart, 6 times as many as in fact probably. That said, are you going to be trading them at 2 o'clock in the morning? Of course you're not. You should be in bed. But whatever. Hourly charts, again, you have a decision to make every hour. 15-minute chart every 15 minutes, 2-minute chart every 2 minutes. And the time frame you choose should be based on what slots along your day-to-day lifestyle. Computer-based, self-employed, retired, something like that. The 4-hour chart can be a really good fit. And you could do that in addition to the daily chart. These two time frames here, I don't like them personally. The 60-minute chart, I feel like if you're trading off a 4-hour chart, you can quickly have a look at the markets, put some opportunities on, and then you can go off and, I don't know, mow the lawn or whatever. Go out for the day, half a day or whatever, and then you can come back and look at the next batch of opportunities. You have more flexibility to slot it alongside daily obligations. Whereas trading off a 1-hour chart, you're going to be looking at the markets for 20 minutes, then you're going to go, right, I got to go rush out to the post office now. You can't really get everything done. And before you're going to be back, then you're going to enter that trade late. You're going to be missing an opportunity. You're going to find it horribly frustrating on a 60-minute chart. In reality, now statistically, the 60-minute chart might be quite good, but I think in reality, in terms of how actually can a trader follow it, I think it's a really complicated time frame to follow alongside our day-to-day lifestyle. I don't think it's a particularly good option. In addition to that, given that most indicators or even price action that a lot of people are looking at are lagging in some form, even price action is lagging, pretty much everything's lagging in a way. then when you're trading the 60-minute chart, what you're doing is if you're looking at the markets at 8, 9 o'clock in the morning, what you're looking at is what's happened overnight. The bias of what's happened overnight is distorting those new opportunities at 8, 9 o'clock in the morning, which means you're trading based on something that happened on very low liquidity. The liquidity that happens overnight, it will distort your indicators massively, which means that it's probably not until the afternoon that you actually have, something that's giving you a trading opportunity that's based on a real volume. And of course, by the time you get to the afternoon, the day is pretty much done. So there's not a great deal more that's going to take place in the day before you bring in overnight again. I feel you're constantly trading against the liquidity curve, if you like, trading off a 60-minute chart. I just don't get it. Carlos, daily trade is about 50 trades a month. You can get loads more. It depends on the number of markets you want to look at, Carlos, but you could probably double or triple that, to be honest. It depends on how active you want to be. So that's my issue with the 1 hour chart. I just feel it doesn't really work, and I've never really given it a go, to be fair, but I don't really feel it makes sense, common sense for it to work either. 15-minute chart, okay, a lot of people like it. Seems to be like the sort of showbiz time frame, but realistically, to do it properly, you need to be in it all day. Probably a minimum of 5 or 6 hours a day. And I don't know about you, I don't want to trade for 5 or 6 hours a day. 2-minute chart, I do different sessions on those on the 2-minute chart. You can have a look at recordings on YouTube. 2-minute chart, you need sort of, maybe let's call it 2 hours. Block of time to trade on the 2-hour chart effectively. That can be a pretty good outcome, because actually, could you allocate 2 hours to trading? Probably. It depends on your lifestyle, of course, and then you can go off and do everything else. So you've got a block of time that you can allocate to this that's actually reasonable and achievable. But for the vast majority of people, daily charts, 4-hour charts can give us a really good opportunity. Okay. So what does it mean? It means the shorter the time frame, the more careful we have to be over markets. So if you're looking at the market several times a day, then you can look at FX, you can look at indices, you can look at commodities. I wouldn't look at stocks so much because the costs and the liquidity tend to be a little bit more iffy. Unless you're trading in a particular way, but really, by and large, FX indices and commodities tend to be pretty good for trading off the 4-hour chart. And you'll probably be in trades for 1, 3, or 4 days, something like that. And that's what we're going to go through today. Okay. So for me, in terms of the benefits of trading the 4-hour chart, it tends to suit a lot of people's lifestyles. So though it's particularly a lot of people who are new to trading, daily charts are probably a good starting point. But actually, you might then think, do you know what? I enjoy it. I'm good. I'm doing pretty nicely. I'm making really good progress. Looking at the markets once a day is fine. But actually, do you know what? I'd quite like to do it 2 or 3 times a day, 4 times a day maybe. And actually I've got the time to do it. I'm not going to get sacked by my boss because maybe I am the boss, or maybe, maybe you're self-employed, or maybe you're retired. At the start of your trading, you might not want to look at the markets 3 or 4 times a day, but maybe after a few months and you're getting the enjoyment out of it, maybe that is what you want to do. And it's something that can typically suit a lot of people's lifestyles. It's a little bit more like sort of holding hands with the market instead of jumping into bed with it, really, I would say. You don't need to trade every time slot. We're going to talk about the best time slots in a second. Good range of markets. It's active, but it's not too active. There's good movement relative to spreads. We're going to talk about moves of sort of 40, 50, 60 points today, which is a decent move relative to the spreads you're going to be charged by your broker, which means it's relatively cheap to do it. And then the trade duration, 1, 2, 3, 4 days, something like that typically, which can be quite low from a cost perspective. Also makes it quite unattractive. Now, best times of the day to trade. What I've done here on this little table is give you an idea of, for our system, everything really starts on a Sunday night at 10 p.m. So basically what you have, Friday night 10 p.m. is the close on the end of the week, and then it all opens again Sunday at 10 p.m. So that means that the decisions that we make 4 hours after 10 p.m. UK time on a Sunday night, 4 hours after that is 2 a.m. Monday morning. Okay, and then the next candlestick will then close at 6 a.m. Monday morning, 10 a.m. Monday morning, 2 p.m., 6 p.m., 10 p.m. That's on our system. Now, different platforms can be different and so on, depending on whatever strategy you're doing, but Trend Signal members would trade it based on these times. Are we trading at 2 o'clock in the morning? Well, I'd like to think you're probably in tucked up in nanites, but who knows? But what I would say to you is that it's probably not the best time to trade. What I've done with this chart table is put in orange or yellow, whatever this color is, the times of the week that are least effective. Okay. So one of the things about Trend Signal is we're really a data specialist. Now, when it comes to daily charts, yeah, sure, there's some days have worked out slightly better than others, like Monday or Friday or whatever. But actually, there's not that much of a difference to warrant saying, oh, I would never trade on a Friday. Actually, Friday is quite a reasonable day. It's one of the top of the days in the week. So there's nothing in there that says a particular day in the week isn't that great. But 4-hour time blocks, there actually are. There are certain 4-hour time blocks that are just not very good, do not generally produce winning trades. We need to know this, okay? And this is for our strategy. For your strategy, it might be different, of course, but for our strategy, these are good times and they make sense. That's the most important thing. If you're going to make a decision, don't just do it because the data tells you, because that could just be random. You need to do it because it actually makes sense for it to not be so good. For example, 2 o'clock in the morning, okay? If you've got a signal for a trading opportunity at 2 o'clock in the morning, and they will come on a 4-hour chart. Of course they will. It's just a candlestick like any other. The strategy that you're using indicators, MA crossovers, whatever it is you're using, or trend signal strategies, it is indifferent whether it's 2 o'clock in the morning, 6 p.m. It doesn't make any difference as far as the look of the chart, right? It's still going to have crossovers at any time in the day. The difference is that the trades that are triggered at 2 o'clock in the morning are relative to very low liquidity. What that means is there's very low amounts of trading that's triggering that opportunity. It's a bit like it's just sort of limped over the line for a trade. And if there's not a lot of oomph behind it, if you haven't got the big banks pushing and driving the market forward, it's more likely to be a loss-making trade. And certainly data would back that up. So 2 o'clock in the morning, overnight trades, save yourself a trading opportunity or two and stay in bed, right? They're not typically great trades. And the reason for that is they tend to be sort of limping into an opportunity at 2 a.m. based on low volumes. It's not really much oomph behind it. And then the market tends to flip the other way. Once Europe gets started, once we suddenly start getting the economic data coming in, and suddenly everything becomes a whole lot more meaningful once we get to sort of 6, 7 o'clock in the morning. 2 o'clock, you're really distorted by overnight price action, which is usually based on not very much. Okay. Okay. What was your first comment, Andrew? I need to look it up now. Okay. Right. Okay, good. Okay. Sound. I was intrigued there. Okay. So 2 o'clock in the morning, not so great. What about these other ones? 6 o'clock in the morning, Mondays, and then Friday afternoons. Well, Friday afternoons for me are not a great time for trading. Why would that be? It's fine for day trading, you understand. It's fine for trading on a daily chart. Not so fine for trading on a 4-hour chart. And it's all relative to how long those trades are likely to be on. Is there any ideas? Has anyone got an idea why Friday afternoons may not be so great for trading? Let me know in the questions box. Type it in. Really useful to get an idea from you guys what you think. Why would Friday afternoons not be so good for trading? And it's got nothing to do with us wanting to be down the pub. We might not want to trade on a Friday afternoon, but it's got nothing to do with why a trading opportunity might typically not be as good on a Friday afternoon, not as successful on a Friday afternoon. Okay, any ideas? Weekend, yep, we're coming into the weekend. The market closes, Ken Lloyd, absolutely. So particularly on FX and the indices, they're going to be shut for the weekend. So, okay, it closes, but what's that got to do with the price of fish? It's a question of what impact does that actually have? Yes, they will be closing, and that's absolutely right. But the impact that it has is that traders will choose to adjust their risk into the weekend. So if you're moving into an uncertain time, which of course is over the weekend, so you can't react to the markets because a lot of markets are closed over the weekend, right? So therefore your risk is open for 2 days, maybe 3 days on a bank holiday. So what happens is that if the market's had a big run up over the week and you get to sort of Friday and you're thinking, probably like to reduce my risk a little bit. And a lot of institutions be like, look, our risk profile is quite high here, but we need to reduce our risk profile as we come into the weekend, our net exposure, if you like. So the number of opportunities we have open, we want to cut that down a little bit. Let's take some profits. Let's close this, this, and this. So you've had a market that's on a big run up. You're likely to see a little bit of profit taking coming into the weekend. You get that a lot on intraday markets as well, coming into the last hour and a half on the Dow or the S&Ps, coming into 9 o'clock UK time PM, 9 p.m. UK time. You get a lot of the same thing. Big run up in the markets often, or a big run down in the markets, you often get a contrarian move coming into the close. And the reason for that is that's down to overnight margin requirements changing on US exchanges. But the reason it happens on a weekend is just to reduce that exposure. So what often happens is you get that little bit of a pullback coming into Friday afternoon, and so on. Now, why does that mean that these opportunities are not so good? It means that trades that are triggering like here, let's call this like Friday afternoon, like here on this curve. That's basically trades that are based on nothing more than profit taking. They're almost like artificial trades in a way. So these turning points that take place on Friday afternoon, unless there's a lot of substance behind them, unless there's like non-farm payroll which is instigating it and so on, it's typically based on profit taking, which is just circumstantial really. And as soon as the weekend's out of the way, then hey, risk may carry on again, and the market's probably more likely to carry on with the trend that it was already there. The markets are more likely to carry on the existing trend unless new news, something else comes to pass. The point basically being is if you're looking to be in a trade for a day, 3 days, something like that, if all you're doing is entering a trade based on profit taking, it's not likely to have many legs in it. It's likely to stop, and then as you come back to the beginning of the next week, the market's more likely to reverse the other way. And what it means is that these trades, these new opportunities that trigger on an afternoon on a Friday, often have very little substance behind them and don't tend to have much life, okay? Therefore, tend to be loss-making trades. All right. Does that make sense, everybody? Give us a quick yes or a no in the questions box. And this is backed up by the data. It makes an awful lot of sense as well. So why would there also be a problem with first thing Monday morning? It's an interesting one, this one. That's nothing more than a hangover, because if you're looking at indicators, again, lagging indicators, which the vast majority of traders use, I use them. I have no problem using them. Some people seem to criticize lagging indicators. Pretty much everything's lagging anyway. That again, if you could end up selling down here, maybe it's just has a bit of a quieter open, you could end up limping into a trade at 6 a.m. on a Monday, 7 a.m. on a Monday, whatever, and then suddenly you're shorting it on the lows before the market has a chance to do what it's got to do. Let's let the market wake up a little bit. Let's let the institutions, let's let the economic data just reawaken. Let's let those portfolios reposition before we put our money on the line, is what I say. So let's allow the market to just gather its thoughts, and then we can have a lie-in on a Monday morning. Why not? Think about the markets a little bit maybe, or just whatever, and start trading a little bit later on. What tends to happen is then you're then more in the normal market cycle. You're not distorted by the over the weekend movement. Okay, that's our experience of this anyway. Your experience might be different. For a particular strategy or trading, you might be like, wow, I love trading on a Friday afternoon, and that's fine. Many ways to skin a cat, many ways to make money. You only need one of them, but that's certainly what we see. Okay. Okay, Paul, quick question. What would be the best strategy for an absolute beginner, i.e. candlestick charts? You can look at candlestick charts, but I wouldn't necessarily recommend price action. It's very, very difficult to see, very discretionary, very subjective, Paul, when you're looking at candlesticks themselves. And also very hard to look at support and resistance, trend lines, really subjective. And unless you've got a lot of skill and prepared to invest a lot of time, you're probably not going to be successful with it. Okay, that's probably the reality of it. Automated trading. So I'd prefer indicators in that regard, particularly if you're new, because indicators give you a steer in the right direction. Now, whether that's trend signal indicators or otherwise, it's up to you. But indicators can help you with more of an obvious position on what's happening in the markets. Now, which indicator you use, which settings you use, that's a whole different minefield. But again, that's something we can help you with, of course. But generally I prefer indicators, particularly for new traders. It's more achievable. It breaks down a lot of the complexities on a visual basis. The other thing, Paul, is automated robots to generate immediate profits. Automated robots are horrific. You got to think about why an automated robot exists. It exists because we want them to exist, not because they work. Okay. Um, how can I say this without insulting anybody? Um, Look, we're all lazy, right? We all want a shortcut. We all want something that's going to give us, instant results. And to that mind, an automated trading system ticks many, many boxes because for anybody, just, we're all the same. We want to get it all done for as little effort possible. It just sounds great, doesn't it? The problem with it is I'm yet to really see any that are consistent or actually deliver over the longer term. And what I tend to find is that they all have these little wobbles. There's one about a year ago that I know a few of our members had used, and actually the automated system, Paul, just had a little bit of a wobble. I say a bit of a wobble. It ended up putting on a few rogue trades or whatever. And this is quite a popular system. This isn't this is something quite a lot of people were on, but it went a bit rogue, or the strategy changed, or the people who used the strategy or developed the strategy then changed it, and the risk profile changed. The point is these things can all happen, and if the system goes a little bit rogue or there's a little bit of a bug in it, you can lose a lot of money. And this system lost 94% of the followers' capital within, I think, 24 to 48 hours because it had a problem. Now, whose responsibility is that? Well, ultimately, it's whoever's funded their trading account with it. It will be your responsibility. And for me, I have no interest in allowing an automated trading system go rogue on my account where it can risk all my capital. Not interested whatsoever. So the risk is, yes, it sounds great and convenient and so on, but the risk can be absolutely terrifying. And I'm not here to say, oh yeah, you're only saying that because we don't have any automated systems. There's a reason Trend Signal doesn't have any automated systems, is because they're horrible. They don't typically work. Sure, some of the investment banks might have them, but that's because they've got people with PhDs in God knows what else and God knows how many things that have built them, and they're robust on systems and so on, and stress tested and traded in quite small size. Retail traders, we're going to be doing all sorts of weird and wonderful stuff with them. And for me, I'm yet to find anything that actually would be, good over the longer term. Like I said, they tend to exist because there is a demand for them, not because they actually work. And they're usually delivered by very faceless organizations where you can't even speak to the person either. All right, so end of the day, you got to do what you got to do, but it wouldn't be my recommendation at all, really. Okay, hopefully that helps, Paul. Okay, what's the best strategy in the morning after 10 o'clock? Well, we're going to talk about strategy in just a second, Moada. We're going on some massive tangents today, but sometimes these tangents can be interesting. At least I think they are. Avi, do people trade on actual need or requirements, or is it merely a speculative business? I mean, a corporation or country may require dollars, so it may put a trade, etc. This would be a genuine. Yes, exactly. So, in the marketplace, Avi, there are speculators, which might be you and I. I don't want to presume about you, Avi, but myself, I'm a speculator. There'll be certain business transactions. If you want to buy a company, you might need to buy an American company. I'm going to need to buy dollars, right? So I've got to exchange my sterling for dollars. Travel, money, if I want to go on holiday, there's a lot of that's going to be changed, obviously. And there's hedging as well. So, there's hedging would be a very big part of the market. So if you think about commodities, for example, commodity market will be all over the place if it was hedging alone. But of course, if you're a wheat seller, which is a farmer basically, you want to hedge the price of your wheat crop, don't you? So you get a lot of participants in the market that are doing it for a business need. What proportion is hedging? What proportion is speculation or whatever? I have no idea. There are investors, there are speculators, traders. There's all sorts of things that go into the melting pot that is the market. And actually, it's that makes it, and that makes the liquidity, and makes it the exciting thing that it is, because there is always a contradiction. There's always an opportunity. There's always that conflict. And that conflict creates, as I say, liquidity, and that conflict creates movement, really. And it's that movement for us that creates opportunity, Avi. Good. We'll talk about the 4-hour chart at some point. Okay, so what have we got then? for me, the benefits of the 4-hour chart. How I trade the 4-hour chart. Actually, this is the wrong title in here. Let's get rid of that. How I trade it. So predominantly, I'll be looking at foreign exchange. That's what we're going to do in a second. So Aussie, CAD, Swiss, Euro, Pound, Yen, New Zealand dollar, US dollar. I'm not really looking at things like the peso or the forints and things like that because spreads and whatever are going to be far too big. So not really interested in it. I say beware of slow and faster outliers. Certain FX pairs are faster than others. For example, Pound New Zealand is kind of on steroids compared to Canadian dollar against the Swiss franc in pip terms. Just be aware of that. It moves a lot faster. Does that mean it's a bad market to trade? No, not at all. It just means you've got to trade smaller trade size. That's really all that it is. Typically, I've been in a trade between 1 and 5 days. What I will do on the 4-hour chart, and this is a really interesting thing, and I do encourage you to do this with your own strategies as well, if you can, or, Trend Signal does this for you, but when you trade on the 4-hour chart, what you have is those 6 time points in the day. What you don't want is your strategy to be distorted by overnight price action too much. You've got to desensitize it. So you don't want too much to be taking place that changes your indicators or affects your price action too much by what's happening at 2, 3, 4, 5 o'clock in the morning. Okay, if you're trading on a daily chart, it's all in one candlestick. It's all there together. If you're trading on a 1-hour chart, or 15-minute chart, for example, you trade certain hours of the day that are nothing to do with 2, 3 o'clock in the morning. And by the time you start trading at 7 or 8 o'clock, actually the markets and the indicators, liquidity is caught up, and you're trading away in the way which you should. The problem with the 4-hour chart is that when you're trading the indicators, the flow of the market can be distorted by that 2 a.m. candlestick and the overnight price action on low liquidity. So what I generally recommend is just slow down your indicator sensitivity a little bit. What I mean, just make it over, say, a longer period, so that it tends to be a bit slower. What that does is it desensitizes the indicator. So if you're a Trend Signal user, you may have noticed this, you may not have, that the D1 accelerator strategy is a much faster setting to the D1 sniper. But on the 4-hour chart, our indicator settings are slower. So the D1 accelerator is the fastest, then the D1 sniper, and then you've got the 4-hour chart. And that's slower to desensitize it for the overnight noise that takes place. Okay. Okay, you want to set and forget. You can do that a bit, with this. And in fact, why don't we have a look at strategy? I'm going to get into it now. So set and forget's okay. I'm not necessarily against it, really. I think you can always outperform Andrew by looking a little bit more actively, but set and forget, generally speaking, is good enough. So what I've got here on my chart is the Australian dollar against the yen. This is a 4-hour chart. Let's have a look at some strategy. The way in which we trade this is broadly similar to the way in which we trade a daily chart. The only difference is, that we're more active with it. Now, certain opportunities that we have are identified by these arrows, but what we're typically looking at, so this is really phase 2 for our traders trading on the 4-hour chart. So the first phase is trading on the daily charts with the big bold snipers that are on there. Phase 2 to then move on to the 4-hour charts if you wish. So what we're going to be doing is focusing rather more on what the chart is telling us rather than what a sniper disc is telling us. So we can really look to trade some of the subtleties to outperform. And the indicators, like I said, are on a slightly slower setting. So they tend to pick up more bigger, more sweeping moves, shall we say. Now, in terms of a set and forget approach, Andrew, what we're going to be doing here is looking at a certain target. First target for me is the ATR. Do we all know what the ATR is, the average true range is? You can type yes or no, and I can come back to it in a second once you've typed that in. So that's a good objective, and we'll talk about stop losses in a second for the strategy too. But what we basically look at here at Trend Signal is a series of factors relative to a turning point. So whenever the market changes color, this line here changes color, this identifies for us a turning point in the market. That is a decision point. That is a repeatable entry point from which traders can make a decision. We can make a decision, you can make a decision. Because whenever the market's changing direction, it's a little bit like saying, oh, the hedge funds, the institutions, this world, they're changing the direction of this market. So if it turns from green to red, you've got a possible short trade there. Okay, as this line here changes from red to green, there's a possible buy trade there. Now it comes down to looking at context. So what's happening in the market at that point that could make this an interesting trading opportunity? Now this is where, as traders, we would analyze things like longer term trends, so the daily trend, the 4-hour trend, indeed, the weekly trend. So look at the higher time frames to see what the bigger picture is doing. What we're also going to do is have a look at candlestick patterns and chart patterns. We can analyze the degree to which markets are overbought or oversold. All of these things are figured into our analysis. And what we do as traders is there are certain patterns that are generally more profitable. In fact, if you put this is I guess in layman's terms, the more things you have telling you that this market's going to go up, the more likely it is that it's probably going to go up, right? So if you're looking at a buying opportunity, you want to look at a buying opportunity for a market that is rising on the daily trend as well, and the weekly trend. And maybe it's also showing an ascending chart pattern, so it's showing higher highs, higher lows. Maybe the momentum of the market is also rising as well. The more of these things that you can tick, 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 the more confidence you'll have over that particular opportunity. And that's really what trend signal is. So we analyze all of these additional factors to determine whether any turning point has got a higher probability of being a successful trade than any other. And what you'll notice on any chart is a series of information. This is what trend signal is, guys, in the simplistic form, okay? Do you use fib retracements in your analysis? Not so much in terms of identifying new trades. We do have Fibonacci in there for pivot points, and also you can use it for targeting and things. What is happening here? For targeting and things, but it's not so much in the actual identification of a new trade, Stephen. So what we have here is we look at this particular turning point here, okay? So there's a turning point, the close of that candlestick, which was at, 10 a.m. on the 26th of July. We have a turn up. The line has changed from red to green. Now, in order to get the odds in our favor, we need an edge. Okay, let's go back to the horse racing analogy. We need to see whether this horse has got a history of winning races. Does it have 4 legs? Okay, is it good on this type of grass? Is the jockey the sort of jockey that would actually wants to ride this horse? You know, because if it's like can't remember. Frankie Dettori, for example. He's a jockey that would like to win races. So you probably find, I might be wrong, I don't know anything about horse racing, but if he's riding that horse, he's probably quite a good horse. And he's probably not going to go on the outsider, is he? Because he probably gets paid based on how successful the race is. I don't really know. The point is, I don't know anything about horse racing. And again, similarly with football, I guess, we've got a marquee player. Is he in form? Is he scoring lots of goals? Are they top of the league? Whatever it is, you would think about all of these things. In trading, you should do the same. Okay. So what we look at here is, well, what's the context there? Well, the 4-hour chart trend, so it's blue here and it's orange here. That's down because it's orange. Okay, it's blue, that means it's up. It's orange, that means it's down. So we're against that, but that's okay. We've also got the daily trend, though, is in its favor. So what we're looking at is the daily chart. We can look at higher time frames if you want to. You don't have to with this system because actually it pushes the information to you. So that means it's a buy, but the weekly trend is up. So we're in relative form. It's an informed football team. The weekly trend is up as well. So again, it's a bit like, well, Man City's been playing in really, really well, and actually it's been playing well for the last couple of years as well. So they're likely to win. They're more likely to win a match than they are to lose a match. And they're just coming back into a little bit of form. And you've also got an ascending chart pattern. So you've got a market that's got a history of doing this. That's what it's doing. And we've got another opportunity to buy here. Okay, so on balance, with the longer term trends being positive and so on, you'd expect this market to carry on higher from here. Okay, that's what this system does. So it identifies for you the patterns. Effectively, the more ticks you have here, the more likely it is, in layman's terms, to be a winning trade. Okay, does that make sense? everybody. Now on the daily charts, when we trade those, we have that all built into the snipers. We don't do that at this point for the 4-hour charts. There are certain opportunities that we use called S4 that have those arrows, but that's only a handful of the opportunities. But what effectively it does, it helps us to build a picture. As an example, okay, if you look at this move down, it ended up being quite a big move. Okay, it was a reasonable enough move. You probably would have got stopped out on it here, but anyway, it was a reasonably big move. But the point is, it's against the trends. It doesn't say CP because it's not supported by a descending chart pattern. It's not there. So the chart pattern's up, higher highs, higher lows, and so on. So therefore, to take a short against that pattern would be quite aggressive, wouldn't it? The daily trend is up, the weekly trend is up, and yet that's a little bit like, speculating on Manchester City to lose a football match. You probably wouldn't do that. You're probably more likely at this stage to bet on Manchester City to win a football match, apart from against Liverpool maybe. But you get the point. So effectively what we're doing here is we're looking to bet on the favourite to lose. Doesn't tend to happen. Okay, so especially when you can get even money. Now you might do it in football because you get better money, you get better odds on it, don't you? But it's not really worth it. At 50-50, you're thinking, no, I'm not really interested in that. So we don't take that as an opportunity. This one we do. Okay, and what's really interesting is this is one of my favorite types of patterns. If you're familiar with the D1 sniper strategy on the daily charts for trend signal, this is like one of the pink snipers, same type of pattern. What you're looking at is a market that's overbought. You're looking at a market that is against all its trends, so against the daily trend, against the weekly trend. It's really going the other way. But, and this is the big but, we're starting to see a descending chart pattern. Now, if you've got a market that's in an uptrend, it's doing this. At some point, you don't know when, nobody knows when, but at some point it's going to start to go into a downtrend. Now, what would that downtrend look like? Well, it's going to start to pick up lower highs and lower lows, right? Okay, so if you've got a high, higher high, higher high, ooh, that's a lower high. So in order for the market to break back down again, it's going to start to put in lower highs and lower lows. Okay, and that's very simple to see when you look at the highs and lows using this chart. But either way, the system does it, because if the market starts to reverse the chart pattern, you can see that. So if we've got a descending chart pattern in an uptrending market, it's here. That's where we are. And we're starting to see the market break down again. The whole market is starting to shift back the other way. It's a little bit like, oh my God, Manchester City's top 3 players have all got injured. Maybe it's about to start having a bit of a bad run. It's that kind of a deal. Something has changed. Something has changed in the universe that's out there to suggest that actually maybe Aussie yen isn't going to keep going up. And we can start to detect those, even though it's a strong uptrend. We can start to detect it by looking at markets that are overbought and the sellers starting to rush back into it, by looking at the market starting to pick up a descending chart pattern. This builds the picture about how we can start to see this market and give us an edge. That gives us a really powerful short trade. Okay, now I appreciate that some of you have been thinking, I can't really see that clearly. It's all part of the course and what we teach everybody, obviously. Remember, this is phase 2 for our members, once they've nailed down the basics on the daily chart. But the point about it is it's all on the chart. It's just a question of picking up and catching the pieces of information that you need to see. But like I said, it's all there. Despite this being a big move down, that is not a valid trade. The only way I would be interested in taking this as a short trade here is if the market had rejected a bit of resistance, big resistance level up at that price. Okay, but I'm not talking about that today. So as far as I'm concerned, that's no trade. That's a winning trade. That's a winning trade. Why? Because they are commonly performing patterns that are going quite well. So what we can then do is we need to think about take profit levels, and we need to think about stop losses as well. Obviously, you need to think about that. There's a couple of things that we look for here. When it comes to a 4-hour chart, we tend to be going for slightly reasonable sized moves. Actually, a good option is the ATR. I asked about, would everyone know what that is? The average true range. The true range is typically, it's not quite this definition, but it's basically the size of a candlestick. Okay, so the true range is basically from there to there. That's the number of pips from the high of a candlestick to the low of a candlestick. It's not quite like that because it's based on, you know, where the market opens and there can be gapping and stuff. But either way, let's just keep it simple. The average true range is an average of that size of a candlestick over whatever period. This is a 14-period average true range. So what we look at is, what is the average candlestick size over the last 14 days? Let's call it 40 pips. That's what we'd expect the market to move in a candlestick. That's a pretty good target because it's relative to the speed in which this market moves. And with the absence of all the other data analysis that one might want to do, it's a really good go-to type target there for the average true range. So looking at this particular opportunity here, let me get rid of all those hieroglyphics. You can see there the buy at 94.98 with an ATR of 41 pips. So we'd be looking for this price to get up to sort of 95.50. Okay, so 98.2 plus 41.3, that's getting us up to 94.40 actually. Okay, so that's the objective. So as long as the market gets to 95.40, well, there's 94.50 hit there before it gets to my stop loss, then we're all calling the gang, right? Yeah, that's going to be a winning trade. As far as stop loss is concerned, there's a couple of options here. What I tend to like to do is look at, you know, this intersection here. This is what we call our aggressive stop loss. I quite like it. It keeps it nice and tight. So where that line changes color, right on that color change there, you see that? The line changing color? That price. So we're going to look at the vector average price. Let's put my cursor over it. That's a good starting point for a target. Okay, we can teach you a bit more to look based on what the market's actually doing, but it gives you a good idea. 94.54.9. Okay, that's the stop loss. So ends up being a pretty nice trading opportunity, about a 1-to-1 trade. What did the market get down to? Well, remember the stop loss at 94.54.9. Oh God, we got about a pip away, but you know that's what the stop loss is for, right? So you know it had a little sniff back again, but it ultimately went on and hit our target. A nice clear stop loss, nice clear way to calculate your target, and a nice clear winning trade. Now, what a lot of our members might choose to do is run trades according to the line of this particular color, but you know this line here, so they might still be in this trade, believe it or not. But for me personally, I'm much more of a put your target in and take your money kind of guy. So I don't like to tend to stay in trades for particularly long. I think you can outperform by staying in trades longer, but you sacrifice that with a much lower success rate. That tends to do your head in a little bit. I prefer actually to be in and out of trades a little bit more actively, but that's me. So there we are. Does this make sense, guys? Let me know in the questions box. Are you all with me so far? Give us a quick yes or a no in that questions box. That will be fantastic. Avi, is it feasible to trade without a stop loss? It is, but I wouldn't recommend it, Avi. I think the problem is if you trade without a stop loss, it's not, you might have discipline to say, oh, if the market gets down against you, you might look to close it out. But that ill discipline can always come in. You've got to be a little bit careful of it. The most important thing about a stop loss is that it needs to be set in the right place. I want you to think of it like this. You need to think about your stop loss placement based on a price where you don't want to be in the trade anymore. Lots of people put a stop loss in. It could be like anywhere, just because, you know, I always trade a pound a point and I always put my stop 100 points away. Always. Doesn't matter what market is. That's what I always do. What the hell's that got to do with anything? You know, 100 points relative to the price you got in, that is entirely random, okay? Because the price you entered at or happened to enter your trade at is random, and therefore the stop loss 100 points away from that is entirely random. So why on earth should your stop loss be there? You're not thinking about it the right way. Your stop loss should be at a price where if the price gets down to your stop loss, you don't want to be in that trade anymore. The chance of that trade being successful is now gone. It is more likely to get worse than it is to get better. Therefore, you do not want to be in this trade any longer. That's how you need to think about a stop loss. Don't do it at arbitrary levels. Don't do it just because it's a nice round number. Do it because, hey, if the market gets down to that level, it's probably going to get worse. Therefore, If I stay in it, I'm going to lose more money. Therefore, I don't want to be in the trade anymore. So many times I've spoken to traders in the past where they're like, oh, I'll put my stop loss here, but then instantly they're back in again, and they're in again, and they're in again. Well, that's because their stop was clearly in the wrong place, because they still have the belief that this market will still go in their favor. If the stop loss is in the right place, you don't want to be anywhere near it anymore. All right, you might be unlucky, you might get low ticked and get stopped out of it, but really the mindset has got to be, at what price don't I want to be in this trade anymore? And therefore, I will set at that level. And in fact, you should think of it this way. If my stop loss was here and I got stopped out there, good. Okay, that's a good thing. Because Avi, if you don't put that stop loss in, forget about whether it's in the wrong place or not. If you don't put that stop loss in, and then you go to bed or you go off for a walk and whatever, depending on what strategy or time frame you're trading on, maybe you found it hard to close. Oh, I can't close it there. It'll probably go up a little bit. I'll close it then. Of course you don't, because discipline for a lot of traders can be challenging. So you think, oh no, I'll have a look at it in the morning. Of course, the morning it's down here. And you think, oh, I don't want to close it here when I could have closed it up here. So look, if the price gets back up to there, I'll just close it then. But of course, it doesn't. And then it's down here. And you think, oh my God, but I can't close it now. Now it's even worse now. I was prepared to risk 100 quid, but now I'm down 300 quid. I can't risk it now. It's just ridiculous. It'll just cane my account. You know what? It'll go back up at some point. Look how much it's already gone. It's bound to go up at some stage, surely. But of course it doesn't. And then, it's down to here suddenly. Now you're down 400 quid, 500 quid, 600 quid. Oh my God. Until you get to a point where actually you think, oh God, okay, right, fine. I'll close out of the trade because I can't take the pain any longer. And then what happens? Well, the market will probably rally from there, and you think, oh, for God's sake. The pain and so on. The thing about a stop loss is, Avi, if it's in the right place, it's the best thing to do. If you don't know where it needs to be, then you need education, or you need to investigate where that best place should be. That's really all I would say. All right. Guys, what do you think? Still making sense? Yeah? Stop losses are important. Don't think it's a bad thing, because if you are still in this trade here, you might say, okay, it's easy, particularly if you're trading with a company like Trend Signal, right? So we're teaching you a strategy and so on. If you get a stop loss, no one is ever going to think that being stopped out on a trade, this is a winning trade, you understand, but no one is ever going to think that being stopped out is a good thing, okay? Ever. And they're certainly going to be like, oh, bloody Trend Signal, you loss-making trade. And that's fine, I get it. But at the same time, thank God we were stopped out there. Because if you weren't stopped out there, and we said, oh, don't use a stop, there are terrible things to do, and look at it, look where it could have gone. Okay, so it really is about sometimes getting that mindset right. Okay, and then you're pretty much up against it then, aren't you? Anyway, look, so that's Aussie yen. We've only looked at one market. What time is it? Oh God, it's 1:30. Okay. I think that's fine. I think we'll probably leave it. I think I've waffled on for probably long enough, everybody. But that's my way. Don't blame me for it. Guys, that's it really. There's a good bit of information there about how to trade the 4-hour chart. If you're interested in strategy, you need some support and help to help you to trade it the right way, we can absolutely do that with our Trend Signal Plus trading program to help you to trade and swing trade FX, indices and commodities. If you're interested in day trading, we've got courses for that as well. We have one-to-one coaching, workshops, indicators, strategies, and simple to follow strategies as well that we can teach you and provide you with. That's it for me. I'm going to call it an end to the session. Hopefully you found that useful today. I definitely went on some massive tangents, but you know what? I often find that they can be far more interesting than some of the subject matter that we might have been going through otherwise. So give me some feedback, guys. If you liked today, that's great. Fantastic. Let me know. And if there's anything else you'd like me to cover off on in future Tuesday lunchtime sessions, again, let me know. The way I look at it is these are about education, and if there's something you need educating on, you need something you're not so sure about, you need some assistance with, do you know what? I'm here to help you as much as I possibly can. All the best, everybody. Have a wonderful week's trading, and we'll catch you next time. Bye for now.